Hi everyone, welcome back to the channel. I'm Courtney Thornell and today we're talking about jumbo loans. If you're looking at properties with higher price tags or living in a high cost area, this video will give you all the details on how jumbo loans work and what it takes to qualify. So first let's break down what a jumbo loan is. A jumbo loan is a type of mortgage used to finance properties that exceed the conforming loan limits set by the Federal Housing Finance Agency, or FHFA. Now, these limits vary by location and are designed to reflect the local housing market. In most parts of the country, the 2024 conforming loan limit is $766,550 for a single family home. However, in high cost areas like certain parts of California, in New York, and Hawaii, the limit is higher and it could be up to $1,149,825 for what's called a high balance loan. Now, if you're looking at a property that costs more than these limits, you're entering jumbo loan territory. Now, the FHFA sets these conforming loan limits every year based on changes in average home prices across the country. Anything above these limits is considered a jumbo loan, which means it doesn't conform to the guidelines set by Fannie Mae or Freddie Mac, the two government-sponsored enterprises that back most conventional loans. Since jumbo loans can exceed the conforming loan limits, they're not eligible for purchase by Fannie or Freddie, which means lenders have to take on more risk. This is one of the main reasons why jumbo loan guidelines are stricter and why you'll typically see higher interest rates compared to conforming loans. Now, jumbo loans can be used for various types of properties, but the most common are single-family homes, multi-unit properties, condominiums, vacation homes, or secondary residences. It's important to note that lenders might have specific guidelines for each property type, especially when it comes to second homes or investment properties. So make sure you're working with a lender familiar with the requirements for that type of property you're purchasing. Because jumbo loans don't have the backing of Fannie or Freddie, lenders take on a higher level of risk. As a result, the guidelines for qualifying are more stringent. Lenders want to make sure you are a strong borrower with a solid financial profile before they approve a loan of that size. For example, you'll likely see higher credit score requirements. Usually lenders look at a minimum credit score of 700 to 720, but some may require even higher. You might see some lenders offering a lower credit score, but then you're looking at higher rates. In addition, the debt to income ratio, or DTI, for a jumbo loan typically needs to be below 43%, and in some cases even lower, to show that you can comfortably manage the mortgage payment along with any debts you may have. Another key difference is the down payment requirement. For conforming loans, you might be able to put down as little as 3 or 5%, but with most jumbo loans, you're generally looking at a minimum of 20% down, depending on the loan amount, your credit score, and other factors. Some lenders might allow for 10 to 15% down, but again, higher risk, higher rate. The more you can put down, the better your chances of approval and getting a competitive rate. Jumbo loans also require you to have reserves, and this means you need to show that you have 6 to 12 months or sometimes even more of reserves saved up. 1 month of reserves is equal to 1 month of principal, interest, taxes, insurance, homeowners association dues. And for jumbo loans, you need to have 6 to 12 months worth of those payments saved after your loan costs, like your down payment and your closing costs. Lenders want to see that you have enough in your bank account to cover your payments if something unexpected happens. It's another layer of security for them, since they're lending such a large sum of money. Okay, now let's talk rates. Jumbo loans usually come with slightly higher interest rates compared to conforming loans. This is because lenders are taking on more risk, again, without the safety net of Fannie Mae or Freddie Mac's guarantees. However, the rate difference isn't always huge if you have strong compensating factors such as a large down payment and a high credit score and low DTI. Jumbo loans also offer adjustable rate mortgage options, or ARM, which can be beneficial if you're planning on selling or refinancing before the initial fixed rate period ends. An ARM can start with a lower interest rate for the first 5, 7, or even 10 years before adjusting annually. It's a way to get a lower rate up front if you don't plan to stay in the home or the loan long term. Now, additionally, some lenders may offer interest-only jumbo loans. And with this option, you only pay the interest for a certain period, usually the first 5 to 10 years. This lowers your monthly payment temporarily. But keep in mind that you're not paying down the principal during this time. It's a good option for those with fluctuating income, like business owners or self-employed individuals. But again, it does come with some risk since your balance doesn't decrease until you start paying the principal. Like with most loans, there will be an appraisal. One thing that's unique about jumbo loans, though, is that lenders may require a second appraisal, especially if the loan amount is on the higher side or the property is unique. This is just another way for lenders to manage their risk and confirm that the property's value aligns with the purchase price. I have seen before that the difference in value can be hundreds of thousands of dollars from one appraisal to another on those higher multi-million-dollar properties. And if this does happen, the lender will lend based off of the lower appraised amount. So if a second appraisal is needed, it's important to know that it could add time and cost to the loan process. However, it ensures that the property is worth what you're paying, which is ultimately in your best interest also. Because jumbo loans are larger and riskier, the underwriting process is typically more thorough. So be prepared for a more detailed look into your financials. Lenders may request multiple years of tax returns, which aren't always necessary for conventional loans, bank statements, and other documents to verify your income and assets. And if you're self-employed, they'll likely ask for additional proof of income stability. Now, this detailed documentation helps the lenders ensure that you have a solid financial foundation to manage the higher loan amount. And being prepared with all of the necessary documents up front can help speed up the process, though. And before we wrap up, if you found this information helpful, make sure to like this video, share it with anyone you know who might be interested in a jumbo loan, and don't forget to subscribe for more mortgage tips. I post new videos every week, so hit the notification bell to be alerted to new videos. So going back, jumbo loans are a great option for financing high-value properties, especially if you're looking at homes above the conforming loan limits in your area. While the guidelines are a bit more stringent and the rates may be slightly higher, the key is to be prepared. Make sure your credit is in good shape, have a solid down payment ready, and be prepared for the underwriting process. So thanks so much for tuning in. If you have any questions about jumbo loans or want to know if one is right for your situation, just drop a comment below or reach out to me directly. I'm here to help you make informed decisions when it comes to your mortgage. So I'll see you next week.